Hello mortgage fans. So we are back doing these video updates. It seems that doing the text version of this is too much trouble. I mean, why would you bother reading an update when you can simply let your ears and eyes do the work these days? So very glad that we're back by popular demand. We're back now in January, which is the traditional time of year when everyone's feeling very healthy, doing healthy eating, exercising. I'm very glad to report I did a personal PB. I put on 5 kilos in December, which wasn't easy. It didn't come naturally. I had to really work at that. Well, the truth is, I actually had COVID in December. Thankfully, I wasn't very ill, but I was very bored. So that seemed to be a big excuse to simply eat and drink my way into Christmas and the new year. So feeling that a little bit now. So I'll certainly be doing the healthy tip from now on in. But anyway, enough of that. You're not here for my disastrous health habits. What we are here for is for our mortgage news. So to start off the new year, I thought it's logical to do a little bit of a review of 2021. That will set up some sort of key themes of what we'll look at in 2022, and then we'll pick things up as they go on a weekly basis from here. So today I'm really going to focus on interest rates, which is really the big thing in our world and obviously a big topic coming out of December. What that means in terms of mortgage rates and best deals, and then also the property market as a whole as well. So that's what we're going to focus on here. So firstly, on that point then around interest rates. So there was a bit of a surprise in December with the Bank of England raising interest rates up to 0.25%, up from 0.1 previously. So just a 15 basis point move upward. So not a huge amount to move. So it's more symbolic than anything else. Specifically in the mortgage market as well, all the mortgage products had adjusted anyway, so it didn't really have any impact in the mortgage world because whether the Bank of England raised interest rates in December or January, February, it was very likely they were going to either at the very end of last year just gone or the beginning part of this year. So that's already priced in terms of mortgages. But what we're going to see then is a sort of that trajectory really carrying on. And please do look at the website update of this. There's a nice graph to sort of illustrate the direction of travel around interest rates, which is very clearly up. However, it's going to be quite gradual and it's going to be very steady over the coming months and years. If you're a geek, such as I, you will look at money market rates. And if you are, we will talk through them at the end. But just to give you a rough idea, how they're looking at the moment is people are expecting 3 base rate rises over the next 2 years, but then only one more for the remaining 3 years after that. So that means in about 2 years' time, money markets expect the Bank of England to be at 1%, but then in 5 years' time, around 1.25%. It's been a long time since we've seen interest rates rise. In fact, it's not since the referendum result in 2016. We've not been in this type of market before. As I say, after the EU referendum, interest rates got slashed, all the stuff that happened off the back of that. Then interest rates were about to go up, COVID hit. So really we're at a very, very artificially low point, and the Bank of England is very keen to move us back up to a sort of natural place. Also, inflation is going to be the big topic of next year. There's no getting away from it. It's not transitory. It's here to stay. There's all sorts of reasons for that, which you can read about elsewhere. But very specifically in our world, that's the direction of travel. Interest rates are going up. However, if you look at this very specifically in terms of mortgages, you will see the best buy rates, so the ones you see online with the meerkats and in the newspapers, all that sort of stuff. Those interest rates will go up. But the caveat I put on that, the rates you see as the very best rates in the market are only applicable to people who are borrowing 60% of less of their property value and or have an extremely straightforward situation. So if you're borrowing more than 60% of your property's value straight away, you don't get those rates. Doesn't matter how good your situation is. And if your situation is complicated, then again, you can pretty much knock that on the head as well. So what you'll find is the majority of people are in a bracket where that doesn't apply to you. In fact, something like about 8 out of 10 of our clients do not get the best rate on the market for one of those two reasons. Either their situation is more complex or they're simply borrowing a high proportion of the property value. Now, the good news there is that the margins on those products are very high. Again, so if you think the smallest deposit you can get away with right now is 5%, mortgage rates are sort of still in the 3% area, and the base rate is at 0.25. That is a gigantic margin. So what I think we'll see over the course of the year is even if interest rates do go up, which they're predicted to do, mortgage rates will probably stay steady. So that margin will decrease, but you won't see rates go up. So that's really good news for anyone who doesn't have a really straightforward situation or more than a 40% deposit. I don't think mortgage rates are going to go up particularly high. They will increase, or the margins will come down. But certainly, you're not going to see mortgage rates spiral out of control or interest rates go up very quickly. No one's predicting that. Markets can't take it, and there's no need because those margins are really, really high. Now, those margins are high as a sort of knock-on thing from COVID, which I don't want to sort of talk about in too much detail now. But they obviously go back into what we're in like the third attempt of trying to do 2020. Those margins went up because there was a lot of fear about what happened in the market, etc., etc. Now, in the mortgage world and the property world, we haven't really been particularly affected. So obviously people have, but as a general rule, we haven't. So those huge margins aren't really justified in my view. So that's why I think you'll see them come down this year. Specifically on mortgage lending, then, to give you a sort of current or bit of a sort of flavour of sort of what happened over the last few years. Last year, so in 2021, was the second largest year for mortgage lending ever. The biggest was 2007. So to give you a bit of context around this, in 2019, 276 billion was lent via mortgages. That did drop in 2020 due to COVID, but only went down to 245 billion, which is interesting. Last year, so in 2021, that could well be over 345 billions worth of lending. As I say, the record is in 2007, which was 371 billion. Now, there's factors in there such as things like the stamp duty holiday, pent-up demand, not just due to COVID, but also due to the referendum, as I mentioned as well. So there's lots of reasons why we had a really good year last year. But there's also another thing this year, is that there is, I think, one of the biggest years ever of mortgage refinancing that's due. So, as you know, if you have a mortgage, your mortgage has a set end date. So it might be at some point in this year your mortgage is up for review. Now, the good news is, if you did your mortgage 2 or 5 years ago, however long you did it, mortgage rates are actually much lower now than they were then. So anyone coming to refinance will still benefit from lower interest rates, even though they're on the path upwards. So you're going to see mortgage figures still being really strong this year, really, really strong. That's even without all those other factors I mentioned. So not really seeing that come back. Also, the biggest thing that drives down cost is simply competition. So last year, I think we saw 7 or 8 major players come to the market, and that just pushes down prices with the big guys as well. Interesting little stat for you is that 85% of residential mortgage lending is done by just 6 banks. So that can't continue forever. You've got people like Starling, he bought Fleet Mortgages, etc., etc. Big mergers, acquisitions. You've got sort of the Virgin Group now really sort of getting into that sort of top 6 sort of area. So competition drives down prices. So that again goes back to what I was saying with interest rates and why I don't think mortgage rates are going to go up too high this year. And also then perfect timing to refinance because you'll really benefit because certainly from the next 2, 3, 4, 5 years, rates are going to continue. So it might be a good idea to fix for a longer period of time. So what does that mean for the property market then? So there's a direct link between mortgage lending and property prices. It's pretty straightforward. If money is free flowing and cheap, people buy more property and refinance more often. That just boosts prices. So that's something I don't think we're going to sort of see stop this year. I saw an interesting poll, I think it was on Reuters, where they spoke to a bunch of experts, and on average they believe that house prices were going to go up about 6% this year. That feels about right. Last year was a really funny sort of year, not funny as in hard, but funny as in strange, because the property market is very potted around depending on where you are. So, for example, the single largest area of house price growth last year was Taunton in Somerset. I think that's because half of London put a surfboard under their arm and went down to the southwest, so that sort of happened. Prices went up by 21.8%. So that just shows you what sort of happens when there's an exodus out of London. The North overall was a winner. Again, 15 of the top 20 regions for house price growth were the North. Just for clarity, I classify the North as anything north of Watford, so that's anything outside of that, includes the Midlands, if you're being slightly more technical. London, where I'm far more interested, was quite sluggish. The region as a whole, I think, went up by 4.2% versus a national average of 10.4%, so still very, very sluggish. And again, that can be dragged down with no international travel, Brexit, COVID, etc. So London was really hit, and there's also that outflow of people as well. However, 4.2% growth is still pretty good. Inflation was still below that figure, so well below 3% as an average last year. So it's still real growth there. I think for the first time ever as well, the average London house price reached over £500,000. I believe it was 507,230 according to the Nationwide. So that's still a pretty strong performance even in the most sluggish region. So how does that play out for 2022? we could see a reverse of that trend. So there's going to be a bit of people coming back to London because this whole hybrid working thing, are people out of London for good? Is it simply just sort of, people want to get out of town for that reason? International markets come back, always a big buyer of London properties is another thing as well. Or there simply be sort of natural sort of equilibrium reached in the market, which sort of happens anyway. I think there will be a bit more of a pull back to London because simply employers are pulling people back to London. It's as simple as that. So it won't be that people are going back to work full time anytime soon. I don't think that's common in many places. But there probably will be most companies where you spend anywhere between, I don't know, 1 and 3 days a week in the office. So if that's going to be the case, which I think it will be pretty much going forward, then you're going to see commutable distances from London doing well. So that's classically London and the home counties, which has been the one that's really lagged over the last, 5 years really since Brexit. So I think that's probably the one to watch because there are certainly areas of Zone 1 in London, like Kensington, even Mayfair and Belgravia, which are really, really down on where they are, even in 2016. So you get to this point where that becomes a good buying opportunity, and that's that natural equilibrium effect of the market. So I think that's likely to sort of play out. So that's what I think will happen in that sense. How the year finished out in terms of interest rates then. So if we focus on what money markets are doing first, unsurprisingly, all money markets were up. So 3-month sterling LIBOR, which is actually changing this year, so probably separately I'll be talking about that. LIBOR is no more, it'll be moving to something called SONIA. That's because some guys at Barclays like rigging LIBOR, but that's a whole other topic which you can Google if you're so inclined. But anyway, that benchmark was up quite a lot to 0.239. I think this is the last figures available up to the 23rd of December. 2-year swap markets were up to 1.21% and 5-year swaps are up to 1.289. So quite significant increases there. And I say, please do look at our website. We put a graph on there. We can see the trajectory, which is clearly moving upward over the last 12 months. So how does that translate into the best mortgage rates available? So variable rates are the cheapest. You can still get sub 1% rates. There's a couple of trackers at 0.89% and a few discounted deals as well. A whole nother topic I'm not going to get into now, but please, please, please be aware if you're looking at variable rates, what they're linked to, whether it be the Bank of England or the lender's own standard variable rate. Because when the Bank of England raises interest rates, it can take up to a month for a bank to move their own internal standard variable rate, which means discount products look artificially cheap. I'm going to come back to that one, but please do look at that. Or more importantly, talk to us. We'll talk you through in more detail. The best 2-year fix on the market was 1.09 and the best 5-year fix was 1.25 and buy-to-let started at 0.99%. So they're probably sort of the big themes of sort of the last year or so and probably what we're going to see going forward. So what we have in 2022, just in a summary, is you're probably going to see interest rates increase, house prices increase, and that's going to be sort of the big story of the year. It's funny when you I don't really do predictions, as you can tell. I haven't really predicted anything, just talking about sort of broad trends, because it's always unforeseen events that trip people up. So you can plan all you want. It's the unforeseen stuff that trips you up, which makes planning pretty much pointless. As an individual and as a company, we plan for 12 months ahead, because I think that's anything you really can do these days. There's any sort of time frame that's realistic. So all things being equal, that's what we'll see. But let's see what happens in the coming weeks. So I hope you enjoy it and catch up with you soon.